Welcome back to AlgoBot, where we break down automated trading strategies for the MetaTrader 5 platform. I'm your host at AlgoBot, and in today's lesson, we're exploring an original, first principles expert advisor called interval overlap escape. This strategy doesn't rely on any traditional indicator, chart pattern, or popular methodology. Instead, it treats every price bar as an interval and measures how much neighboring bars overlap. Over the next several minutes, you'll learn how that single geometric idea generates entries and exits, how it adapts to each market on its own, and how the code puts it all together. Let's get started. So what exactly does interval overlap escape do? At its heart, this expert advisor rethinks what a price bar represents. Rather than reading a bar as a candle with a body and wicks, the strategy views it as a price interval, simply the range of prices between the bar's low and its high, the zone where trading actually took place during that period. The core idea is to compare each bar's interval with the one before it and ask a single question: how much of their price space do they share? To answer that, the strategy calculates an overlap coefficient, a ratio between 0 and 1. When it's close to 1, the two periods traded over almost the same prices, which suggests buyers and sellers broadly agree on value. When it's close to 0, the current period is transacting at prices the previous period had largely left behind, which suggests order flow is relocating to a new region. This approach can be applied to any symbol and any single time frame you attach it to: a foreign exchange pair, an index, a metal, because it reads only raw high and low data. What makes it self-adapting is that it constantly measures the market's own recent overlap behavior, learning a local average and a local spread, and it judges each new bar against that moving baseline rather than any fixed number. In terms of who it's designed for, this is an educational tool aimed at traders curious about systematic, rule-based logic and how a statistical anomaly can be defined without a conventional indicator. As always, remember, this is analysis for learning purposes, not financial advice, and every approach to the markets carries real risk, including the risk of loss. Let's walk through the logic step by step. First, the strategy works on completed bars only. A new bar gate makes sure it evaluates just once per finished bar, so it isn't reacting to every incoming tick. On each new bar, it measures the overlap coefficient between the bar that just closed and the bar before it. That's the shared price span divided by the combined price span of the two intervals. Then it builds a picture of what's normal right now by looking back over a window of previous bars, governed by the BalanceWindow parameter, which defaults to 40. Across those bars, it computes the average overlap and the dispersion, or how much overlap typically varies. Importantly, the candidate bar itself is excluded from that calculation, so the comparison stays honest. Next comes the escape test. The strategy sets a threshold equal to the local average minus the CollapseZ parameter times the dispersion. CollapseZ defaults to 1.2 standard deviations. If the current overlap falls below that threshold, the bar is flagged as a statistically anomalous loss of cohesion. The market is escaping its recent value region. Detecting an escape isn't enough on its own. The strategy also needs a direction. It reads the interval midpoint, the halfway point between a bar's high and low. For a long, the current midpoint must sit above the previous midpoint, and the close must finish above that previous midpoint. The interval relocated higher and price accepted the move. For a short, the mirror applies: midpoint lower and close below the previous midpoint. Risk control is scaled to the market's own volatility. The strategy averages the high-to-low range over the range window bars, defaulting to 20. The stop loss is placed at stop multiple times that mean range, defaulting to 1.5, and the take profit at target multiple times it, defaulting to 2.5, roughly a reward to risk of 1 2/3 to 1. Finally, there's a concept-driven exit. If overlap climbs back above the local average while a position is open, the market has re-equilibrated. The escape idea is invalidated, and the strategy closes early. Otherwise, the stop and target manage the trade. Here's the heart of the MQL5 code as you'd see it in Meta Editor. At the top are the input parameters. BalanceWindow, defaulting to 40, sets the lookback for learning the local overlap regime, its average and dispersion. CollapseZ, at 1.2, is how many standard deviations below that average the overlap must fall to count as an escape. Range window, at 20 defines the window for the mean range volatility figure that scales the stop and target. Stop multiple and target multiple at 1.5 and 2.5 set those distances, while lots and magic define the order size and identifier. Below that is the escape detection. The code computes a threshold equal to mu minus CollapseZ times sigma, and the collapse flag becomes true only when dispersion is meaningful and the current overlap sits below that threshold. If there's no collapse, the function simply returns. Then direction is decided from the two interval midpoints. The bull condition checks that the current midpoint is above the previous one and that the close finished above the previous midpoint. When bull is true, the strategy reads the ask price, sets the stop below entry by stop multiple times the mean range, sets the take profit above by target multiple times it, and calls trade.buy. The bear condition is the mirror image, current midpoint below the previous one and the close below it. When bear is true, the strategy reads the bid, places the stop above entry and the take profit below, each scaled the same way, and calls trade.sell. Both sides share identical logic, just reflected in direction. Let's bring this to life on the chart. Below the candles, you'll see a subpanel plotting the interval overlap coefficient, scaled from 0 to 1. Two reference lines matter. The upper line marks the local average overlap, and the lower dashed line marks the collapse threshold, the average minus 1.2 times the dispersion. When the coefficient dives beneath that dashed line, the strategy sees an escape. Look at the opening bars on the left. Price is drifting sideways in a tight value region, and the overlap coefficient sits high, up around 0.7 or 0.8. Each new bar shares most of its price space with the one before it, so buyers and sellers are essentially agreeing on value. There's no anomaly here, and the strategy stays flat. Now watch the fifth candle. It lifts sharply, opening and trading almost entirely above the prior bar's range. Because its interval barely touches the previous interval, the overlap coefficient collapses, plunging beneath the dashed threshold line in the subpanel. That's the escape signal. To choose a direction, the strategy checks the interval midpoint. It has relocated upward, and the candle closes above the previous midpoint. Both long conditions are satisfied, so a long position opens at the buy entry marker. The stop loss is set below entry at 1.5 times the recent mean range, and the take profit sits above at 2.5 times it. Follow what happens next. The two candles after entry continue to push higher, each carving out fresh ground. The market is building a new equilibrium at a higher level, exactly as the escape idea anticipates. By the time price reaches the take profit target marker, the long trade closes for a gain in this illustration. Notice that overlap stayed low through the run, because the trend kept relocating price, so it was the take profit, not the early exit rule, that completed the trade. After that, the market settles. A couple of bars overlap heavily again, and the coefficient climbs back above the local average line, telling us cohesion has returned at this higher region. The strategy waits patiently because there's no anomaly to act on. Then the mirror scenario unfolds. Watch the 11th candle drop sharply, trading almost entirely below the prior bar's range. Once again, the intervals barely overlap, and the coefficient collapses beneath the dash threshold. This time, the interval midpoint has relocated downward, and the candle closes below the previous midpoint, so the short conditions are met and a position opens at the sell entry marker. The stop loss goes above entry, and the take profit below, both scaled by the same mean range multiples. From their price extends lower, printing a fresh low with each bar as order flow relocates the value region downward. When price reaches the take profit target marker beneath the entry, the short trade closes in this example. Just like the long, the reward distance was set at 2.5 times the mean range against a stop of 1.5 times it, keeping the reward to risk near 1 2/3 to 1 on both sides. Step back and notice the symmetry. In both trades, the sequence was identical. A calm regime of high overlap, then a single bar whose overlap collapsed below the adaptive threshold, then a directional read from the midpoint and close, then a risk-scaled position that rode the relocation to its target. Nothing here depends on a fixed price level or a named indicator. Every decision came from the geometry of the bars themselves and the market's own recent behavior. Of course, not every escape follows through so cleanly. Sometimes overlap rebuilds quickly and the early exit rule closes the position, and sometimes price reverses into the stop loss. That's why the strategy defines its risk in advance on every trade. This walkthrough is an idealized illustration for learning, not a promise of how any real sequence will play out. Let's wrap up. Today we explored interval overlap escape, an original expert advisor for MetaTrader 5 that treats each bar as a price interval and measures how much neighboring intervals overlap. We saw how it learns a local overlap regime, flags a statistically anomalous collapse as an escape, reads direction from the interval midpoint, and scales its stop and target to the market's own recent range. We also walked through the code and a candle-by-candle example of both a long and a short. Remember, everything here is educational content only and not financial advice, a recommendation, or a solicitation. Trading carries real risk, and losses do occur. If you found this breakdown helpful, please like the video, leave a comment with the strategy you'd like us to analyze next, and subscribe for more MT5 strategy analyses. You can find more at www.algobot.live. Past performance does not guarantee future results. Trade responsibly.